So I've set up my assumptions for the forecast, and now I can actually build the forecast. So my sales would be last year's sales times 1 plus the growth rate that we assumed. Let me set up my formatting here. Copy formats from historical, but then I want to make them black. Cost of goods sold would be sales times the percent. Cost of goods sold is percent of sales. And nice thing, we've got this formula set up for subtotal. So for gross income, I just drag the formula from historicals. That's fairly straightforward. SG&A expense would be sales times SG&A as percent of sales. EBIT, I've got the formula, I can drag it. Interest income is a little bit tricky here. I'll need to set up a separate schedule. So let me maybe leave this out for now. And just for now, I'll kind of make this lime yellow or lemon yellow, and come back to this later. Unusual interest expense, let me zero it out. It's been 0 in the last year, so I don't expect anything non-recurring. Income taxes. So this would be EBIT plus interest income minus interest expense minus unusual expense, if any, multiplied by the tax rate. Which we assume to be 24%. And then net income, we've got the formula, I'll just drag it. EBITDA, I'll extend the formula. It doesn't capture any depreciation, but we'll build it out. So we've got income statement forecast more or less in place. And, some of these numbers, I mean, we don't have interest expense, they wouldn't be final. So as we go, I would not suggest that you analyze, kind of see, whether the numbers make sense, because they could be pretty different from where they should be. So until we're done with our financial model, you can't really analyze it. So cash and short-term investments, I will link it to this ending cash schedule that we have built. So this is what I mean by you can't analyze. It's 0, but that's okay. Short-term receivables. So this would be the reverse of days of sales receivables. So this would be DSO, days in accounts receivable, multiplied by sales divided by 365. Just the reverse of the formula that I had on my slides. Inventories would be days in inventory, 70 times cost of goods sold. That's what I've used to set up the driver, divided by 365. Other assets, I think I'm got a driver for that. Other current assets as percent of sales, 0.9%. And then total, we can drag the formula. Net PPME, so would be beginning balance plus CapEx, but CapEx is with negative sign, so we'll actually say minus here, but we are adding a number. So CapEx is in line 88, placeholder for now. So plus CapEx minus depreciation. Depreciation is a positive number, so I'll subtract depreciation. Again, I haven't populated it yet, so it'll kind of be the same numbers in prior year, but it will flex soon. Intangible assets. These ones, let's keep them flat. When we do LBO, we will kind of play with this line. But for now, we'll keep it flat, and we'll do the same for deferred taxes and other assets. So remember, like when I said, like whenever it's a smaller line or something that we don't really know how it will change, we'll kind of keep it flat. Short-term debt and current portion of long-term debt. So getting into liability side. I would like to set up a special depreciation, special debt schedule. So let me create another section here called debt schedule. So I'll set up the debt schedule, and some of it will be placeholders, and we will populate it as we go. So the first couple lines, they'll be more clear a little later. I'll call them minimum cash and cash flow before revolver. I mentioned that on my slide. So we'll have three types of debt. We'll have short-term debt, which is the revolver. Then I'll have a current portion of long-term debt. And then we'll have the long-term debt. So each schedule will kind of have similar layout. So I'll have beginning balance. I'll have a pay down, which is a negative number that will go down, or drawdown, positive number. And then ending balance. And then we'll have interest rate and interest expense. So these schedules will be standard. So I will just copy these headings for the next type of debt. At the end, I also have interest rate on cash. And interest income. So this is my debt schedule, because I started referring to it. I wanted to have it set up. So let's just do one. Let's do long-term debt. I think that will be a little bit easier. So ending balance of long-term debt, we have it for January 2020. So I'll link that to my balance sheet. We've got that. And then they don't split short-term debt and current portion of long-term debt on the balance sheet. So I guess we have to look at 10K here. So you can see that in fiscal 2020, which is calendar, so in fiscal 2021, see, yeah, in fiscal 2021, they are expecting 2.35 billion of debt to mature. So this would be calendar 2021. So we are in calendar 2020. So this amount would be current portion of long-term debt. Current portion of long-term debt is debt maturing in the next 12 months. So that's what I will put here. So I'll link it to this 2350 number. 1750, if you were curious, matures this year. So this would have been in current portion for previous year. At least approximately. And I'm sure from accounting perspective, it's much more complicated than that. But if we have to approximate, which is quite often what we have to do, let's use this approach. So that was current portion of long-term debt, basically debt maturing in the next 12 months. And then for revolver, then it would be the remainder. So we'll take short-term debt and current portion of long-term debt minus this amount. So 1291. Again, just approximation for now. And then for the next period, beginning balance equals ending balance so for long-term debt, we've got the maturity in our assumptions. Again, here, I'm not suggesting that long-term debt would go down by 1750. I mean, this is maturing debt, but it's already in the current portion. So I'll use the number from next year. That's by how much. So first it kind of transfers into current portion of long-term debt, and then it gets paid off. So from that perspective, for the current portion, it's really just the change in this debt maturing. So like if it goes up here, that's how much the current portion of long-term debt goes up by. So it's just a change in the maturing debt. So that's the pay down, draw down for current portion of long-term debt. So it goes up by 621. Let me leave the revolver line for later. We'll have to build a pretty, I mean, the formula I had on the slide, but I don't want to get there yet. I will set up the balance so that we can use it for the balance sheet. Well, let's maybe just finish it up with the interest rate and interest expense. So we have the assumption on our assumptions tab. So we've got the interest rate on debt here. I'll use the same number for all of the debt, just for simplicity for now. In reality, it's different, and there are rates in the 10K. I'll kind of just use one number for now. And then the interest expense, I'll start with 21. It's average of beginning and ending balance times interest rate. I think I mentioned that this creates circularity, so we'll have to be careful with it. I think I can even copy and paste this formula because it's all kind of standard. And then I'll just extend the interest rates. And these schedules should be fine. So we've got interest expense calculated, interest rate on cash. I'll take it from assumptions, 2.4% in fiscal 2019. And then interest income would be average cash. Times the interest rate. Zero in later years because we don't have it modeled yet. So let's go back to balance sheet. So here, short-term debt and current portion of long-term debt would be sum of the ending balances for these two types of debt from the debt schedule. Accounts payable would be days accounts payable times cost of goods sold divided by 365. Income tax, I'll keep it flat. Total current liabilities, I've got the assumption 9% of cost of goods sold. And then total, copy the formula. Carry it across. Long-term debt, that'll come from the debt schedule. So ending balance of long-term debt. Deferred taxes and other liabilities, I keep them flat. And then common equity would be the beginning balance plus net income minus, well, I guess minus, but it's with negative sign already for dividends on cash flow statement. So it will be dividends and share buybacks, change in capital stock. Now you see that our balance sheet doesn't balance, which is fine. We're not done yet. Let's move on to cash flow statement. So we got net income linked. Depreciation, we have assumption in our assumption. So depreciation as percent of PPME is 8.5%. So for these lines, I guess I could zero them out because we're not really forecasting them. Or we could also take the difference. Let me maybe do that. Let me take the difference. So this will be deferred liabilities with positive sign plus change in deferred tax assets. It's 0, but I've kind of built a formula. And then other, in these two, just for completeness, I've built them out. And then changes in working capital. So let's build these 6 lines here. They're actually fairly simple. If you didn't follow what I've done with these other 2 lines, you'll kind of understand it now, because I'll do it a little bit in more detail. So for short-term receivables, I mentioned on the slide that when assets go up, that means that your cash goes down. So increase in assets results in decrease in cash. That's why I can just take it like this. I'll say minus, and then I'll take receivables this year minus receivables prior year. So they're going up, so it will be cash outflow. And I think they're all listed in the same order. So receivables, inventory, and current assets. So I'll just copy my formula down, and then for payables, I have to change the formula. You know, when I was setting it up, I didn't do it correctly. Short-term debt shouldn't really be included. So in the liability side, I've got accounts payable, income tax payable. Oh, I deleted that, and then current liabilities, other current liabilities. That's the one that needs to flow through cash flow statement. Yep, I got that. Okay, so accounts payable would be current balance minus prior year balance. Other current liabilities would be current balance minus prior year balance. And then net operating cash flow would be the total. It will be sum of funds from operations plus all these changes in working capital. I've got an extra line, I'll delete that. Typically, working capital for growing companies is negative. Changes in working capital is negative, and that's the way it is here. For some reason, inventory jump up a lot. I guess a small rounding in my assumption resulted in a pretty big change. Okay. CapEx is percent of sale based on our assumption, 2.1% multiplied by sales. And then I would actually not expect any other items. They're kind of one-off, really. I mean, most likely they will happen, but it's very hard to forecast them, so we'll just put in 0. And CapEx has to be negative. Cash dividends paid. It depends on dividend policy, but you know, it's been fairly consistent here. I mean, there were ups and downs in share buybacks, but you know, they have been paying both dividends and doing share buybacks. Let me maybe base it on prior year. I'll just keep it flat. And then issuance and reduction in net debt. So this would be from the balance sheet. Kind of same logic as we've used for current assets. So this would be both current and long-term. So it will be current balance minus prior balance plus current balance for long-term debt minus previous balance. So, you know, this kind of transfer from long-term to current portion that I did, but, you know, you can see that here, when we aggregated them, we're paying down exactly what the maturities are. And then other funds, I'll keep it at 0. I wouldn't expect any changes in exchange rate. Again, it's hard to forecast and too detailed for this kind of financial model. And I think these lines we can just copy and paste. So one thing that's left for me to do is I'll just copy minimum cash here, but it's build the revolver, pay down, drawdown. So the formula, if you recall, like the basics of it is, let's take all cash flow from the company, excluding cash for the revolver. So, you know, all the cash flows there are on the cash flow statement. Let's just pick up the right rows. So I'll start with net operating cash flow and then add up investing cash flow. And then I'll include dividends, and then, you know, these other lines, which is 0. For debt, I also want to include these other 2 types of debt. So this is basically cash flows not before we need to draw on the revolver. I would also like to include cash as available to pay down the revolver. I'll include cash from prior year, but I don't want to use all of it. I'll say that cash minus minimum cash balance. So basically what it means is I'll draw the revolver as long as my cash stays at this minimum. So I'm getting 573 as cash flow before revolver. And then pay down, drawdown. Remember that simple formula equals negative minimum of beginning balance. So we don't want to pay down more than our balance. It's that or cash before revolver. So in this case, we're actually drawing on the revolver. You know, we've got a lot of dividends, we've got debt maturities, but the good thing, it's not out of line. It's kind of modest fluctuations here. And actually, by the end of our forecast period, we actually do pay down the revolver. So to me, it looks fairly realistic. So we'll remove that. And then the nice thing is that now our balance sheet balances, right? The check is in line, it's 0. We haven't finished dividends or we haven't finished interest expense, but we've made the balance sheet balance. So let me link interest income to my last line here, 38. And interest expense would be these 3 lines. So it'll be short-term debt, long-term debt, and the revolver. Just checking to see that's kind of flowing through properly. All right. So that really completes the core model. We'll then go into DCF and then LBO.